Okay, so we did a stock split, which sends a positive signal. And now there's something called a reverse split, which is going to send the negative signal. Okay, and this is fairly rare, but it's the exact opposite of a stock split. Okay, and the goal of this is you're trying to increase the price. Okay, share price. Now you could make the argument, what's the difference? It really doesn't matter what it trades at, but there are reasons why you might want to increase it. Like if your share price is below $1 per share, you might be delisted from certain exchanges and things like that. So why is it a negative signal? Because this is sort of a last resort by management. Okay, so what they're saying is we can't think of any other way to raise share price, but we need to get it increased to get into a certain range. So this is how we're going to do it. An example would be, in this case, you would do a 1-for-10 reverse split. And let's suppose the stock trades at $2 per share. And you have 30 shares. Okay, so you have $60 worth of stock in this company. Okay, so after the split, okay, you're going to get one new share for every 10 that you hand back in. So you had 30, therefore you have 3 shares of the new certificates. Okay, and the share price will be the opposite. So this will go up, so it will become the original $2 times the 10, so it'll be trading at $20 per share. So you can see it's still, your total is still $60. Okay, so there's no change from that point of view, but the negative signal is that this is the only way they could think to get it up to that price range. And it's a little more complicated than a stock split, because a stock split, you're just issuing shares, so you print them out and hand them in. In this case, you have to collect the shares and issue a new share. And that's why it's a 1-for-10 type of thing. And if you don't have the right number, then you just get paid the difference. If you had like 3 leftover shares, it would just buy you out with cash. So those are the key things to go through. Let's do a bit of a summary in terms of what happens to the share price. The earnings per share, and if you look at the cash dividend, the share price will fall by the amount of the dividend on the ex-dividend date. Earnings per share will stay the same. There's no change. Okay, what happens with the share repurchase? Technically, this share price should stay the same. It may go up in reality for a signal, but not financially. There's no financial reason for it. Earnings per share would increase in that scenario. Okay, so those are usually the 2 alternatives that both involve cash. The other things like the stock dividends and splits and reverse splits, those are non-cash items.